Welcome to week 4 of financial management for nonprofit organizations. Today we're going to start off with reviewing a few key accounting principles. The first one involves the term to recognize. And it means to recognize means that you are recording a transaction into your financial records. And a transaction is either revenue you have received or an expense you are paying. And to recognize these means you have actually entered this into the financial records. And the primary issue around recognizing revenue and expenses is the timing of when you recognize them. And this leads us to the principle of accrual-based accounting. In accrual-based accounting, you record your expenses and your revenue when they are actually incurred, regardless of when cash is exchanged. You recognize your revenue, you recognize your expenses when the services have been occurred, not when payments have been made or received. So it's all about the timing. Let's start with revenue. Very often a nonprofit is going to perform the service, it's going to do the work, and then later the grant is going to pay for that service. Other times the nonprofit's going to receive a grant, but the work is to be done over the subsequent months or at some future time. Regardless, the revenue must be attributed to the time the service was performed, not when the payment was received. That's called accrued revenue. So you get a grant in the mail for 1 month, but you've done the service in another month. It is recorded, it is recognized the month the service was performed. And it's the same with expenses. Generally, an organization is going to incur an expense like payroll, utilities, purchases, and you'll be billed for them later. Even payroll, you make your payments and payroll after the end of that pay period. But in accrual-based accounting, you record that expense when it occurred, when the people did the work on your personnel, when the utilities were used. And you record it then rather than the following period when it's going to be paid. That's accrued expenses. Now, there are several other kinds of accounting processes that you should be familiar with, and the second most common after accrual-based accounting is called cash-based accounting. And in cash-based accounting, you recognize, that is, you record the revenues when the cash is actually received in hand, when the check arrives, and you record your expenses when they are actually paid, when you have written the checks. And again, it's all about timing. In cash-based accounting, you have your revenue, and whether the nonprofit performs the service, does the work before the grant will pay, or whether the nonprofit receives a grant for work that will be done in the future, the revenue is recognized when the check is received. And again, with expenses, it's exactly the same. Your organization will incur expenses like payroll and utilities, make purchases, and you'll be billed for them later. In cash-based accounting, the expenses are recognized when they are paid, not when you incurred them, when you actually have written the checks. So let's compare cash versus accrual accounting. A cash basis is a much easier accounting system, and it gives a very realistic view of cash on hand. You know exactly what cash is in the bank. However, it does require a disclaimer on annual reports, and it doesn't show revenue or expenses that are in process, i.e., grants that you've been promised, pledges you've been made, grants that will pay after the work is done. It doesn't show any of that, so it gives you a very limited view. Accrual-based accounting does give a much more complete picture. It's much more accurate because it shows revenues that will be coming in and expenses you will in the future have to pay. However, it is much more complex and is a much more time-consuming way of doing your accounting. Now, the GAAP, Generally Accepted Accounting Principles, and the IRS will require accrual-based accounting. Most of your funding sources will require accrual-based accounting, so there isn't a whole lot more to discuss. Some very small nonprofits, especially without paid staff, may certainly choose a cash basis accounting for the ease of the accounting, and that is perfectly acceptable. And I want you to be aware of what's called fund accounting. Fund accounting, and this is only in nonprofits, creates a separate ledger account based on each funding source. And typically we know our funding sources might be unrestricted, temporarily restricted, and permanently restricted funds. And fund accounting does use accrual-based accounting. So, for example, you might have a donor having made a restricted grant that can only be used for a certain purpose. Or you may have a government contract or multiple contracts, each to perform certain specific services. You may have all other donations that are available for any use, unrestricted funds. So each funding source will have its own account, and each of these accounts will record the revenue and expenses specifically for that funding source, that account, and what was needed to perform those services. And the purpose is entirely to ensure accountability, that expenses are only made for the purposes of that funding source. Depreciation. Depreciation is based on the concept that the value of anything, the value of an asset, is going to decrease over time. You've noticed if you've bought a car that the next year it's not worth as much. So a computer, a piece of machinery, etc., is worth less the second year, third year, etc. So this monetary reduction in value, called the replacement cost, is built in over the life of this asset, not just at the time you've purchased it. It's easier if we discuss it as an example. Say your nonprofit buys 10 new computers. The IRS has determined that computers have a 5-year lifetime. So you only have to record part of that total expense for the 10 new computers at the time that you purchase them. The balance of that expense will be recorded as an expense over the subsequent 4 years. In essence, you're spreading the pain of this new expense over the life of the asset. Another concept is called the dual aspect concept. And this means that every transaction is going to consist of 2 changes in the books, which must balance each other. For example, if an organization buys a building outright for $500,000, Their cash account is going to be reduced by $500,000, and their fixed assets are going to increase by $500,000. The Financial Standards Accounting Board has standardized nonprofit accounting reporting. And among many other things, it's defined what a complete set of financial statements should include. And you'll be pleased to know you already know many of them, and by next week, you'll have learned all of them. They consist of the statement of financial position, the statement of financial activities, the statement of cash flow, accompanying notes, and the statement of functional expenses.